In July 2026, Bloomberg uncovered something strange happening in some of the most expensive zip codes in America. Beverly Hills, Malibu, Bel Air. Homes worth tens of millions, owned by people who could buy their way out of almost any problem. Except this one. A growing number of these homeowners have been quietly pushed onto California's FAIR Plan, the state's insurer of last resort, built for the riskiest, lowest-income properties in the state. A handful of zip codes now carry $44 billion of that plan's exposure alone, a figure that has ballooned since 2022. Experts say the numbers could bankrupt the program designed to catch everyone else. If insurance is straining under the weight of mansions in Malibu, what does that mean for a family in Ohio, or Georgia, or Texas, with a fraction of that net worth? This was never really a story about insurance. It's a story about the American dream and the quiet paperwork holding it together. For generations, that dream was simple. Work, save, buy a home. Insurance was the invisible seatbelt on that promise. Nobody thought about it until the day it wasn't there. To understand how that seatbelt started coming loose, go back to a much quieter letter arriving in an ordinary mailbox. It doesn't look dramatic, just another piece of mail. But inside, a homeowner reads their premium has doubled, or that their policy won't be renewed. Right now, more than 12 million American homes carry no insurance, not because owners don't want it, but because they can't afford it, or no company will sell it. Nearly half of those uninsured households earn less than $40,000 a year. A fire or flood doesn't just damage their house, it erases everything they own, with nothing to catch the fall. For a different group, the wall shows up even earlier, before they move in. Across Louisiana, a growing share of mortgage applications now collapse, not because buyers can't afford the house, but because no one will insure it. No policy, no loan. No loan, no keys. It's why first-time buyers now make up only 21% of the housing market, down from 40% before 2008. An entire generation quietly filtered out, one denied policy at a time. Even homeowners who keep coverage aren't fully safe. Let a policy lapse, even briefly, and the lender force places its own insurance, protecting its investment, not the family, at a far steeper price. The safety net just got smaller and pricier. For decades, the deal was simple. Buy a home, and if disaster strikes, a check helps you rebuild. That deal is being rewritten in fine print, and nobody voted on it. So what changed? To understand that, you have to understand a machine most Americans never think about, until the day it stops working for them. Picture a giant shared piggy bank. Millions of homeowners drop a small amount in every year. Only a small fraction ever need to take money out after a fire, a storm, a burst pipe. The company holds the rest in reserve, invests it, and profits from the gap. Insurers track that piggy bank's health with one number, the combined ratio, how many cents go back out in claims for every dollar collected. Above 100, the company is losing money. In 2025, the U.S. industry's combined ratio hit its best level in a decade, according to AM Best, on paper, a healthy profit. No single company wants to be wiped out by one disaster, so insurers buy their own insurance, reinsurance, from a handful of giant global backers. When a hurricane or wildfire tears through a state, reinsurance keeps the system from collapsing, a safety net worth hundreds of billions a year. When reinsurers raise prices to cover disasters anywhere in the world, retail insurers pass that cost down to you. A flood in Australia can raise your premium in Ohio. The entire system was built on one quiet assumption, that disasters stay rare and spread out. In 2025, that assumption was tested harder than ever. At first glance, the result looked like good news. It wasn't. In In 2025, U.S. property insurers posted their best underwriting result in a decade, more than $60 billion in profit. It sounds like the crisis is over. It isn't. That profit came down to one factor. Hurricane claims fell 90% that year. One quiet season covered a system still cracking underneath. While hurricanes stayed calm, a different threat exploded. Severe convective storms, tornadoes, hail, violent wind caused $82 billion in damage worldwide, most of it in the U.S. A single tornado outbreak in March alone cost billions in days. These storms don't hit the coasts everyone worries about. They hit the middle of the country, where high-value homes sit exposed with almost no warning. To manage a risk shifting this fast, insurers turn to something more powerful than a weather forecast. AI models, including Google's DeepMind, can now track a storm's path up to 15 days before landfall. But the more unsettling shift happens quietly between storms. Insurers increasingly evaluate homes using satellite imagery, aerial scans, and catastrophe models that score neighborhoods block by block, house by house. A homeowner can lose affordable coverage without changing anything on their property. A satellite flags dry brush 2 properties away. A neighbor's roof ages past a certain year. An algorithm quietly recalculates wildfire odds for an entire zip code overnight. The house didn't change. The map did. And when the map turns against a zip code, it doesn't just affect one house. It starts to reshape the future of entire states. Behind every number here sit the same 4 forces. Wildfires and storms are the most visible. Rebuilding costs have exploded too. Lumber prices spiked during pandemic shortages, and labor shortages mean every repair takes longer and costs more than a decade ago. Lawsuits add to it. Nuclear verdicts, judgments over $10 million have surged, costing the industry tens of billions annually. And when global reinsurers raise prices to cover disasters anywhere on Earth, retail insurers pass that cost down the chain to homeowners who had nothing to do with it. Start in California, where the FAIR plan has grown faster than any private insurer, exposure now in the hundreds of billions. Wealthy communities like Calabasas are increasingly among its fastest-growing customers. After the January 2025 LA wildfires cost the plan billions, regulators approved a 29.1% statewide rate hike, effective this October. Since 2020, insurers have non-renewed millions of policies in fire-prone zip codes. Take a homeowner outside those enclaves, no claims history, nothing unusual on paper. Their insurer declines to renew, citing wildfire risk. Their only option? The FAIR plan itself, a stripped-down policy covering little beyond fire and smoke, sold at a higher price than before. Nothing about their house changed. Their zip code did. In Florida, the average homeowner now pays more than $8,000 a year, still the nation's highest, even as last year's sharp spike slows. Paying doesn't guarantee help. Florida carries some of the highest claim denial rates of any state. Nationwide, the industry's 5 largest insurers left more than 44% of claims unpaid last year, up from 36% a decade ago. In Colorado, premiums have more than doubled in 5 years, the fastest climb in the country, driven by wildfire and hail. In Louisiana, homeowners face some of the highest premiums in the country, on top of a mortgage market where insurance costs increasingly sink deals. And in Texas, a market once called stable, premiums are climbing again. Proof no state sits this one out. Across every one of these states, the pattern repeats. Homeowners who did nothing wrong are absorbing costs that used to belong to insurers alone. The insurance industry has always talked about managing risk, but somewhere in this story, risk quietly stopped being their problem and became everyone else's. Insurance was never really the story. It's the quiet paperwork behind something much bigger. The idea that an ordinary family could buy a home, build equity, and hand something down. Take away reliable insurance, and a house stops being an asset, a liability no bank wants to touch. The UK pools flood risk nationally through Flood Re. Japan's government absorbs the cost of major earthquakes directly. Australia built a multi-billion-dollar pool just for cyclone damage. Canada is building a national flood program of its own. Each decided some risks are too large for private companies alone. The Federal Reserve has flagged the danger. As banks and insurers retreat from coastal and fire-prone regions, it warns that isn't just a housing story, it's a risk to the stability of the wider financial system. Globally, the gap between what disasters cost and what insurance covers reached $424 billion in 2025. Behind that number are millions of families rebuilding alone, with no check coming. Which brings us back to Bel Air and Malibu. Homeowners with some of the most valuable properties on Earth now lean on the same safety net once reserved for the riskiest, least protected homes in the state. If the promise strains there, it strains everywhere. This was never really a story about storms, satellites, or spreadsheets. It's about whether owning a home still means what it meant to past generations. A place where, no matter what happens, someone helps you rebuild. The house is still standing. What's being tested is the promise that made it worth building in the first place. Thank you for watching. If you enjoyed this documentary, please like, share, and subscribe for more stories like this.